Welcome to CEF Insights, a series of discussions with leading closed-end investment managers. Today's presentation on allocating assets features Brian Cordes, Senior Vice President and Head of Portfolio Specialist Group, and Doug Bond, Portfolio Manager, both of Cohen Steers.
Hi, everyone. Thank you for joining us today. My name is Brian Cordes, and I'm thrilled to be joined today by Doug Bond. Doug is the head of closed-end funds at Cohen Steers, and today we're going to be getting his thoughts on the closed-end fund market and his outlook for 2021. Before I hand it over to Doug, though, I did just want to highlight that the closed-end fund market is coming off a very successful year of new launches. In 2020, we saw approximately $8.8 billion raised in new offerings. That's nearly twice the amount that we saw in 2019. And roughly $1.25 billion of that was actually in the Cohen Steers Tax Advantage Preferred Securities and Income Fund, which trades under the ticker symbol PTA. Now, one of the reasons why there's been so much enthusiasm in the closed-end fund market is the new closed-end fund structure, something that we call closed-end fund 2.0. And in this new structure, the sponsors are assuming the entire cost of the fund launch. So the sponsors are covering the financial advisor compensation, all underwriting and operating expenses as well, meaning all of investors' dollars are going to work immediately. And in addition, many of these new fund structures have been structured with a term feature, which will allow investors to potentially tender shares at NAV at a specific date in the future. And we believe that this feature helps reduce the risk of closed-end funds trading at a discount over the long run, since the market will factor that into that eventual tender into its pricing of these funds. Now, case in point here, you can see that the funds launched in 2019 and 2020 in that 2.0 structure. We've seen those their market prices hold up significantly better in the days and months following the launch relative to those in the older structure. So with that, I want to turn it over to Doug now. And Doug, thanks for joining us today.
Thanks, Brian.
Doug, why don't you start us off just by giving us a little bit of an update? What's the size of the closed-end fund market today, and what are the major sectors that are available to investors in that market?
Well, Brian, thanks to sort of this revitalization of the closed-end fund IPO market that you talked about in 2019 and 2020, the closed-end fund market's actually been growing lately with that new issuance. And so today, as you can see on a slide, the market is roughly 3 times the size that it was in the year 2000. So it's about $240 billion in market cap versus $80 billion 20 years ago. And there's a lot more selection and choice and sort of the really 3 primary sectors of the closed-end fund market are equity-focused funds, taxable fixed income focused funds, and municipal bond funds. Within equity category and within the taxable fixed income category, lots of different selection, lots of different types of funds. And for someone like Cohen Steers, or a person like me who focuses on the secondary market opportunities, the growth and expansion of this marketplace, much more selection opportunity, creates an opportunity to generate alpha in portfolios.
Great. And when you're evaluating closed-end funds to invest in, how important are the discounts as a part of your process? And what do those discounts look like today versus where they've been historically?
Well, the discount is a part of the investment opportunity. We've got a slide that sort of gives you a level set of where discounts are today. The short story is they're about where they have been on average over the course of the past 20 years. So in our world of closed-end funds, what we saw in March of last year, when discounts got out to the 20-25% area, is very, very unusual. So where we are today, the average closed-end fund selling at about a 4.2% discount. The equity closed-end funds are a little bit wider than their long-term average, about mid-fives discounts versus a long-term average around 5. Taxable fixed income funds are a little bit tight to their long-term average. And then the muni funds are also a little bit tight to their long-term average. So in terms of the importance of discounts, we've also got kind of a slide that shows what the dominant source of return is for an investor in equity, taxable fixed income, and municipal funds. And what you can see is that the longer or further out in the future you go, the more important is the asset class in the total return experience. On a short-term basis, say a daily basis or a monthly basis, the discounts can play a decent role in what your investment return is. If that's your horizon, trade them for a day, own them for a day, own them for a month. But when you go out to sort of a year plus, you're talking about 2/3 to 80% of the total return is based on what's going on in the asset class. The only exception I'd say to all this conversation about discounts is if when discounts are greater than 10% in munis or greater than 10% in equities or greater than 10% in taxable fixed income. The discount can be a really great signaling opportunity and generally get really good forward 52-week returns, but it doesn't happen that often.
Right. All right. So Doug, thank you for that. Right now, of course, in this historically low rate environment, everyone's looking for income and there's a lack of it available. But closed-end funds have historically generated some nice income. What are the current yields looking like today? How's it stack up historically? And how does it compare with other asset classes?
Well, we've got a slide that sort of summarizes the yields on the far left, taxable fixed income securities, then equities. The current yields today are just shy of 8%. And that is right there with the 5-year average current yields of around 8%. And in the muni closed-end fund area, the current yields are a little bit lower than their 5-year average at 4.7%. And of course, those are one of the reasons people look at the closed-end fund market, because they're significantly above where you can buy corporate bonds with sort of average yields of 1.8% today, or the 10-year treasury. On the slide, it's 90 basis points, but I think spot to today's date, it's about 110 or so, or the muni bond index available at a big yield of 1.2%. So one of the draws of the closed-end fund market is the above average current income opportunity. And they're pretty much in line where they've been over the course of the last 5 years.
Yep. All right, so we talked a little bit about income there, but what about from a total return standpoint? What's kind of the profile been there for closed-end funds compared to other asset classes?
Well, what I would say is that on a 20-year basis, the broad closed-end fund market has generated a total return of about 6%. The fixed income closed-end funds, taxable fixed income closed-end funds, are about 7.2%. And those returns are about in line with U.S. corporate bonds or U.S. high-yield bonds. And in fact, also in the same zip code as the S&P 500 at a 6.6% level. More recently, the past year, with the S&P 500 up over 18%, the broad closed-end fund market averaged like 3.2% return. So certainly the last year, you would have been better to ignore the closed-end fund market in most cases. And be long the S&P 500. Of course, one of the things that we didn't really get into before is the amount of dispersion of investment returns in the closed-end fund market. And so the top 15 closed-end funds averaged about a 50% total return. The bottom 15 closed-end funds averaged a minus 74% return. So there's a fair amount of variation around that average return of around 3% during 2020. And if you were excellent in your asset class selection and fortunate to get involved in some of those top 15, there's some significant performance opportunities. Not surprisingly, the best performers in the closed-end fund market last year were focused on tech. And those are the names that were up 50, 60, in some cases 70%.
Okay, and look, we've got time for one more question here, and it's the one everyone wants to know. What's your outlook for the closed-end fund market here in 2021?
We're constructive and we're optimistic. We think as the vaccine distribution continues, we think that the reopening trade that really we saw get a significant push in early November, right after the election last year, will create a constructive backdrop for increased levels of economic activity. The Fed has signaled that it's going to continue to keep short rates pinned. That's good for closed-end fund valuations because as the Fed keeps the short rates pinned, closed-end funds, which frequently borrow to finance the leverage in their capital structure, have a very, very low borrowing cost, and that's supportive of the earnings power and the income power of closed-end funds. In fact, in the last two periods where the Fed had the short rate pinned at 1 or coming out of the financial crisis in 2008, even lower than 1 at 0 to 25, on average, closed-end funds traded at NAV. So the fact that we see closed-end funds available today at around their average discounts historically suggests to us that over time, we're going to continue to see those closed-end fund valuations tighten so that you'll get some benefit from discount compression and then whatever's going on in the underlying asset classes. And where we would be favoring in terms of a portfolio setup is some of the deeply discounted equity closed-end funds, convertible funds, which are equity sensitive and available at sort of 10% discounts, covered call funds, option income funds, which are selling at broader than long-term average discounts, and then multi-sector bond funds, which allow fixed income managers to quote unquote go anywhere where they see investment opportunity. In fact, in January, there was a $2 billion launch of a multi-sector bond fund to take advantage of opportunities that the manager that launched that fund saw in those areas. So we're constructive. There will be bumps. There'll probably be some things that happen that we don't expect. But from where we are as a setup today, we actually feel like we have a good year ahead of us.
Great. Well, Doug, I want to thank you again for joining us today and your thorough commentary as always. And I want to thank all of you for joining us today as well. If you'd like more information on the closed-end fund market, please visit cohensteers.com. And again, I want to thank you all for your attendance today, and thank you to CEF as well.
Thank you for watching. We hope you'll join us for our next CEF Insights discussion.